Hi traders, in this video I'm going to outline to you some of the key drivers of gold at the moment. I'm going to show you what to look for, what's driving gold, what could drive gold higher and what could move gold lower so you can be prepared in advance. So in this video we're just going to outline exactly what's driving gold right now. And understanding what's driving gold is really going to help us have a good understanding of how to trade gold. You see, recently we've seen gold move in this 1830 to 1680 range. Now, the first thing to realize is why there was this sudden fall in gold. So this fall in gold came on Friday the 6th of August when there was very strong NFP data. With the revisions, nearly 1 million jobs extra were added. So that means that US normalization was expected to happen more quickly. In other words, this is heightened expectations for a taper announcement from the Federal Reserve at the Jackson Hole Symposium on the 26th to the 28th of August. So as a consequence, the strength in the dollar has weakened gold. Now let me show you in particular what is moving gold particularly. If you have a look here, we have an overlay on the chart. Now on this chart, we have an overlay of gold prices, which is in blue. We have a proxy for real yields, which is red. And we have the dollar index, which is purple. Just set a dollar index for a moment. And what we see is when real yields fall, gold rises. And when real yields rise, gold falls. So remember that 6th of August date, we suddenly saw US 10-year yields push higher. Now that pushes real yields up because real yields is just US 10-year yields minus inflation expectations. So what the bond market was telling us is that bond traders are expecting a sooner hike from the US than they were previously after very strong jobs data. And it's no surprise that we know that the Fed is very focused on US jobs and it's a key metric they want to see met. So as the US 10-year yields moved sharply higher, we saw gold move sharply lower. Now at the same time the 10-year yields moved up, we also saw the dollar index moving up. So the dollar strength plus the US 10-year yields not the US, plus the real yields moving higher, all of that weakened gold. So understanding the driver in gold is understanding the relationship with real yields, gold, and the dollar. As long as expectations are there that the Federal Reserve are going to taper and are going to move more quickly on policy normalization, that is a pressure for gold to the downside. So dollar strength and real yields rising will keep pressuring gold. Now, if, say, September comes and the jobs print is very, very poor, say it misses expectations wildly, then we'd expect real yields to fall sharply again, the dollar to fall sharply, and gold to push higher. So gold is being pushed and pulled around by these three things. The movement of real yields, secondly, the movement of the dollar, thirdly, expectations on the Federal Reserve's taper timing. So by keeping those three balls in the air, as it were, and recognizing which one is moving, that will help you identify the next near-term direction in gold. Gold is obviously a topic we're speaking about a lot, and it's a topic that I'm covering many times a week. So if you would like to find out more, please do come along to one of our workshops on a Wednesday, or maybe one of our look ahead webinars on a Monday, and I will be explaining the smaller moves as they come along and what to look for as we make our way through this gold market, and we look at key technical areas where it's sensible to find sellers and buyers and how we can structure positions around the current outlook for gold. I hope to see you there.